An equity is a fractional interest in a business in its simplest form. In New Zealand, we refer to a fractional interest as a share, and those shares trade on the New Zealand share market. In the United States, if you turn on CNBC, CNN, or another television show, they will refer to the stock market. They refer to fractional interests as stocks. So that may assist those beginning the investment process in understanding some of the different terminologies around fractional interests in businesses, shares, stocks, and equities. They are all the same thing. When you purchase a share or a fractional interest in a business, you are purchasing a small stake in that business and in turn a percentage of the profits. So if we think about a company that we all know and have all heard of, Nestle, and we purchase shares in Nestle, so we purchase a fractional interest in Nestle, one of their famous products around the world is Kit Kat. So when we purchase a fractional interest in Nestle, we are purchasing a small percentage of the profits of every single Kit Kat bar sold around the world. When we invest in equities, we purchase a share, a stock, a fractional interest in the business, as we explained earlier. We think about many different things. One of the first things we think about is the competitive advantage of the business and what advantages this particular business has. And if we think about Nestle, one of their key advantages is the brands that they have within their portfolio. For example, Milo, another key brand within their stable, a brand that many of us purchase every day at the supermarket. We also then need to think about the future prospects of an industry. And we always hear a lot about technology companies, but there are very real risks with technology companies. And again, I'll bring it back to a product that we all know. There are very low risks with a product like Purina's Friskies. And for the simple reason that people tend to care more about their pets than their relatives. So we have to think about operational risks facing the business, risks facing the industry, the wider industry in which the business operates, regulatory risks, the long arm of the government coming in and imposing regulation on us that we weren't expecting, and most importantly, the risks around debt. So we have to assimilate all of these factors, and I've only touched on a few, to work out what price we are willing to pay for a business. Price is what you pay. Value is what you get. So there's three ways we can assess the value of a business. The first way is quite simply to take the business that we are looking to invest in and compare that business to other similar businesses that may be listed on other stock exchanges around the world. An adjunct to that is we could also then look at what is called past industry transactions to look at what other experienced industry operators have in turn paid for similar businesses in the past. So the second valuation methodology the industry might look at is to look at the cash flows the business generates. And a business is worth the sum of its future cash flows. And typically what the industry does is discount those cash flows back to the present. It's a complicated process. It sounds complicated. It is, and I caution on that. I liken it very much to looking through the Hubble telescope. You turn it a quarter of an inch and you can end up in a different galaxy. So you have to be very careful when assessing a business's cash flow. There's a number of assumptions which in turn creates its own valuation risk. The third methodology that the industry utilises is replacement cost, or more commonly referred to as sum of the parts. And this applies to asset-heavy businesses, property companies, utilities, energy companies. And that is another methodology that the industry uses to assess value. For more information, please check out the following websites.